Welcome to the latest episode of High Stakes. I'm Paige Soya, Managing Director of K Street Capital. Today's episode is going to be about multiple exits with Martin Tobias, who's a fellow GP in the venture space, who has been through exits on all kinds of sides. But before we get started, Martin, maybe if you want to just introduce yourself, a little bit about your background, and then maybe we can talk about your exits from a founder perspective, and we'll switch over to some of the exits you've had as an investor.
Okay, yeah, thanks for having me, Paige, and I love talking about this conversation. So I'm Martin Tobias. I'm the managing partner of Incisive Ventures. It's my second fund. We're a small $10 million pre-seed fund out of Seattle. We invest in B2B software companies. I say that software that reduces friction at scale. When I was a venture partner at Ignition, we led the first round of DocuSign, and DocuSign is exactly that kind of thing. You're doing something in software, signing a contract on your phone instead of printing out a PDF file and faxing it. There's millions of signatures on millions of contracts a day. That's the scale. I'm looking for more of those kind of things. I've invested as an angel in about 250 companies, as a VC in about 74 companies. I'm an LP in 17 funds, so I'm also a venture investor, and I've been a 3 times venture funded CEO, raised over $500 million for my companies and 2 IPOs there.
Super cool. So maybe let's talk about the 2 public company exits that you have, or maybe not, maybe we don't want to call them exits, but public company transactions and how those went.
Sure. So the first one, I was at Microsoft, and this is in the mid 90s, about 96, and it was the beginning of audio and video on the internet. And PCs, you didn't have a sound card and a video card and all that standard. You had to buy those things separate, and streaming was just starting, and compression and stuff like that. And what I saw is, I said, hey, there's this whole opportunity of how are you going to get the traditional media, which was CDs and VHS tapes and Betamaxes, onto this new digital format? You need a service provider in the middle to do all that at scale. So let me start one of those. And I started this company called Loud Eye Technologies. We raised, a $5 million first round. And 3 years later, we went public in March 17th of 2000. This was definitely the last exit, or the last IPO of the dot-com boom. The peak of the NASDAQ was March 21st. And what I say about bubbles is it's better to be inside of them than after they have burst.
You had perfect timing on that one.
That's true. It was very popular. I mean, we were, the on trend. Everybody was doing digital media. We had $10 million of revenue, and we got $2 billion market cap for a $10 million revenue company.
Wow.
I knew we were in a bubble. I knew we were at a high price, and that's how the IPO happened. We were actually 80 times oversubscribed, and there was actually a mispricing problem that happened. We filed it at 12 to 15, and we had 80 times oversubscription on the book from the bankers, and about 20 times oversubscription in terms of market orders from the retail. And so what that meant is that it was going to pop on the first day. And so I talked to the capital markets guy, and I said, hey, can we price this at like 30 or 40? And they're like, no, there's no way we could ever do that. You should price it at 16 and pat yourself on the back and call it good. And I said, yeah, but then you're stealing money from me as a company. And they're like, oh, no, this is how it's done, blah, blah, blah. So they priced it at 16. The first trade was at 48.
Wow. Oh my God.
So, and what happened, this is a cautionary tale about that exit. First of all, an IPO is not an exit, it's just another financing event for the company. CEOs like me and everybody's locked up for 6 months. Secondly, you got to be concerned about what price you're getting. And in that case, because the company priced it at 16, they sold the 100 million shares at 16, raised $125 million. Okay, but if we had priced it at 30 or 35 or 40, closer to what the first trade price would have been, we would have raised like $300 million for the company. And what happened, my underwriters actually got sued. The practice back then was this thing called laddering, and they actually got sued for it. And the reason they couldn't price it is because they had back in deals with the big purchasers like Fidelity and all these institutions, where they bought it at 16, they flipped it at 48 to the retail people who were dumb, and they made hundreds of millions of dollars. those people actually made more money on my IPO than I did. And this is something people need to understand when thinking about an exit, especially like an IPO. Who's making the money and what's the motivation of the buyers and the structure of the transaction. And, you know, it was still fine. We had $120 million and okay. But, you know, I wish I had known about this concept of laddering and pricing and things like that when I did the IPO there for Laudai. And the other thing that happened, of course, you know, the Wall Street Journal published the value of my shares like that. It was over $500 million on that day, but it wasn't $500 million in my bank account. I was locked up, I couldn't sell. And the other thing that you need to do if you have one of those exits where you're an executive of a public company, you need to say, what are you going to do to diversify your concentrated position? And there are these things called exchange traded funds that you could do and other things. You can do option strategies. So you need to figure out what you can do to preserve that or to get some liquidity when you're locked up.
Absolutely. So you were locked up for 6 months, interestingly, as the last IPO of the .com era. And so making sure I heard you correctly, you really only raised 1 round of capital and then you sold
2 rounds of venture capital and then we went public. And that was a very unusual time. I mean, it was just 4 years from starting to going public. And the average time for starting to going public at that time was more like 7 years.
Right.
And so that was an incredibly fast time. And if you think about it today in 2024, the average time to go public is like 12 years.
Yeah.
So that was a very different time. I actually hope that we go back to a more reasonable time, maybe 5 years and a public market that's willing to take early companies. It was funny because like we went public and then 1 week later, Expedia went public. And Expedia's, you know, still around, but Expedia went public for about the same kind of, you know, thing, selling $100 million on a $400 or $500 million valuation type of a thing.
Okay.
And, you know, that public markets used to take companies public, you know, doing that kind of deal. Now they're rarely see a company that goes public under $1 billion and a lot more revenue. But I think it's a more efficient capital market if slightly earlier stage companies can go public.
So what happened at the end of your lockup? I guess at that point, you know, you're dealing with the share price of the day. And did you end up selling your shares? Did you end up staying? Were you in handcuffs at that point? Like, how long did they want you to stay on board?
Well, you know, the market had corrected significantly since then. Our first trade was at 48. By the time the lockup came off, I think the stock was down to about 8. And so it was under the IPO price, but the entire market was down 60–70% by then because the .com bubble had burst. And of course, the board wanted me to be locked up longer. So, and they didn't want me to sell, and they knew that I would sell or that I might sell. So in that case, the board, because they had $125 million in bank, they offered me an extended lockup in exchange for a loan. So they loaned me a big pile of money, and the loan had a repayment schedule in it where basically every quarter I would sell back to the company a certain number of shares to repay the loan that was based on the price of the share. So I did that, and that worked out okay because I wasn't selling in the public markets. I was selling back to the company, and the company was using its cash. So in that case, the company did that deal. I also did 2 exchange funds, and these are options that are always available to executives in companies that go public. So what banks do is they'll go around and collect 40 or 50 people that have concentrated locked up positions in newly public companies. They'll put them all together into a fund. And so you get diversification, and that fund holds the shares for 5 years. And at the end of the 5 years, the fund sells the shares. So what you're doing is you're getting diversification without selling. So it's not actually a sales transaction. You give the shares to this fund, the fund holds them for 5 years. And so I did that with about $10 million of shares in the company. And the nice thing about that is I actually got a benefit of that because my shares went down significantly, but some executives from Google gave their shares and other companies. So the total value of the fund was quite significant at the end of that exchange thing. So I would encourage executives that have an IPO to consider those exchange funds or loans from the company or some other things to get liquidity, reduce the float or to reduce.
Yeah, that's a great takeaway that I don't think anyone has talked about yet, because it is an interesting process when you are taking your company public and you're locked up. There's so many things that can happen in between and they're out of your control.
I mean, even if you wanted to sell, you have disclosures, you have trading windows, you can't sell around your earnings or things and stuff like that. So there's lots of other strategies you can do. You can do private sales. I mean, if you're lucky, you do what Mark Cuban did, which is, arrange a block sale of all your Yahoo shares to somebody else all at once.
That's smart.
Yeah, when he sold broadcast.com to Yahoo, he arranged a block trade and sold $3 billion of Yahoo shares at once that was underwritten by Morgan Stanley. So Morgan Stanley bought the shares and then took the responsibility for a discount and then took the responsibility for selling them in the open market. That's another strategy you can do, is sell them to a third party at a discount that takes the liquidity risk.
So also, I know you were on the board of Cloudmark. Is it Cloudmark for about 12 years? Yeah, and that company went public while you were. Were you an investor also, or were you?
It didn't go public. It ended up selling to Proofpoint.
Okay, right.
Yeah, so that company went public. That was about 13 years from starting to exit.
Very different story.
Yeah, it's a very different story. It was in the anti-spam space. It was early in the anti-spam space, had one of the leading products. It grew pretty well, but there were other companies like Proofpoint that raised more money and got more PR and stuff. And so Proofpoint was able to go public. And there were 2 or 3 companies that went public before Cloudmark. So Cloudmark ended up selling to one of them because they were not big enough at the time to go public themselves. And so that exit turned out that you were sort of number 3 or 4 in the market. And in that case, you're probably selling to another company instead of being able to go public yourself. In Loudeye's case, we were the leading digital media service provider, the brand. We had good PR. I mean, I've been on the cover of Wired magazine and many times your exit abilities are determined, by things like that. Like, are you a leader, or do you have the public profile to be able to do an IPO versus a sale?
Exactly. So this company that you're talking about was actually just acquired by Proofpoint, and this was in 2017, right?
Yeah.
This time period.
Yeah.
So maybe talk about the market environment then. Also was a pretty decent, I think, exit time period.
I had invested through Ignition, and I think we were in at single-digit millions, and they sold for 110, and they had raised 2 or 3 rounds of financing. I think it was like a 6 or 8x, which is not terrible. It's a decent exit, but it was a good technology, and the team made money, and everybody made money. And Proofpoint was happy because Proofpoint was what a lot of times happens, and what I did not do with Loudeye, which I should have done, is if you are able to go public, like Proofpoint was, you can use that currency to buy competitors and to build your revenue on EBITDA accretive type deals. So, I think that one of the ways Proofpoint made the Cloudmark thing make sense is they said, okay, the public market's giving us this kind of multiple on our revenue. We can buy Cloudmark, which has revenue at a lower multiple, and that becomes accretive to our share price because the public market will give us a higher multiple on the revenue that we're buying. And that's why they bought them. And many times, if you're trying to sell a company to another company as an exit, that's what you're doing. You're selling it at a lower multiple. Hopefully it's still a good return for your investors, but that's why the buyer's buying, is that they think they can get a higher multiple on that revenue by adding you and consolidating the market. That's exactly what companies that were built on M&A have been doing forever, like Cisco and those kind of companies.
Exactly. I want to go back to Loudeye for a second, because I was going to ask you, when you went through that transaction, you did talk about the laddering experience, and I imagine you sort of maybe wish you knew about that going into it, but were there other things that you wished you'd known that you kind of learned from going through that process?
Well, I wish I knew more about what really motivated and how investment bankers, made their money, to understand how to negotiate differently as a CEO. For example, there's this thing that the underwriters all do. They ask for a 10% shoe, they call it, extra shares. And basically what that is shares that the investment bank is going to buy and then sell to somebody else if the company ends up popping and trading at a higher than a listed price. It's basically, you're basically giving them a free option to make money on your company. And they're going to give you less money than you could get if you were to sell those shares to the public. And you don't have to give an investment bank the shoe. And I wish that I had known that, but basically you're giving somebody a free option. And they made more money on their shoe than they made on the fees for the underwriting of the company.
Oh, wow. Yeah.
The investment bank did. And I wish I understood how investment banks made money and what their motivations were a little bit better.
You mentioned maybe it was the underwriting company or something that's sort of going through their own litigation or whatever had to deal with that. Was the laddering, what was not legal about that whole situation? Or was it all legal and it just became sort of unethical?
No, it was illegal, and the lead underwriter was Hambrick and Quist, and you can, I think, Google Hambrick and Quist and laddering with the. What it ended up doing, it ended up basically violating the insider trading rules, because basically the banks had undisclosed deals with these buyers. So they would go to their big institutional buyers and they would say, we can give you an allocation here, but you have to do a certain amount of trading with me. You have to rebate me some money in other commissions. They had undisclosed commission deals for that thing that they didn't tell me as the CEO about, and they didn't tell the public about.
Right. Okay.
So it's all about disclosure. These companies.
And that was illegal at that time also.
It's illegal to have an undisclosed commission arrangement with a client.
Yeah.
Yes.
As it should be.
It should be, yeah. And they had those, and they were proven, and they paid fines.
So I'm
But they
curious.
didn't change the fact that the company got, a third of the capital that it should have.
Right. I mean, that's the unfortunate thing about it, right? It's challenging when you're a founder and you've created a lot of the value for many years, and then you're seeing other people come in at the last second for 6 months and walk away with, huge pockets.
More money than you did. And that exactly happened with Loud Eye.
Yeah. Unfortunately, we do see that more often than you would think, even today. But it's good for people to hear this, right, and learn about it so that when they go through it themselves, they know.
And you need to think about, when you're considering an exit, what's the motivation of the people that are offering you the exit, right? Is it an investment bank? How are they going to make money on this transaction? Is that a fair deal? Is there any way you can change the way they're making money, or that you can get a bigger piece of the pie?
Right.
In any exit scenario, if somebody's buying your company, they're buying it for a reason. And they think they're gonna make money, and you need to understand that. Whether it's a company buying it, like, Proofpoint buying Cloudmark. I as a VC, I've had 2 exits, partial exits in the last month, and they were both different. But I had to look at who was buying in that case and why, and understand, what their motivation for buying was, and that can relate to my desire to sell based on their motivation to buy and stuff like that.
Yeah. And actually, that's what I wanted to talk about next, because now you're on the other side of the table making the investments and seeing the exits. And especially if you just had 2 in the last month, right now in 2024, where the market is very weird. And you're not seeing a lot of exits. You're seeing a lot of secondaries and recaps and things. But I don't know. And these are all, in my mind, they can be considered a type of an exit, I suppose. But I'd like to dig on the 2 recent ones you were mentioning and how those were structured, why you decided to get out or to sell or whatever the situation was in this current market.
Another thing I wanted to discuss about exits is there's a difference between a complete exit where you're selling the company wholesale or a partial exit. And for example, an IPO is a partial exit. You're selling some shares, usually all primary shares from the company, maybe some secondary shares, but you have to hold the shares and hope to trade them in the future. The 2 exits that happened this last month, they were both in CPG companies, not software companies, that were very profitable and growing very well. The first one, the company I invested when the company was doing about $200,000 of revenue. It was profitable at that time. They did $210 million of revenue last year.
Wow.
They had like $70 million of cash on the balance sheet. And basically the company offered some earlier shareholders the ability to sell because they basically did a stock buyback the company did a stock buyback. So you've got this company that's incredibly successful, 11% EBITDA margins, $210 million of revenue, growing 300% year over year. So you've got an offer to buy some shares, and I looked at the price, they were offering about 1.8x revenue and about 13 times EBITDA as a price. And I called a CPG banker friend of mine. The first thing I did is I said, is this a fair price that they're offering relative to public market comps? And the guy said, yeah, that's pretty fair price. It's actually about a 20-30% premium over what public comps trade at. So first of all, is it a fair price? Then the second question is, I have this thing, I was about 8x up on my investment. And the question is, do I sell all of it? Do I sell none of it, part of it, or all of it?
Exactly. And investors, I just want to say, for other angels who maybe aren't professional investors, but even if you're an angel, this comes up all the time. Like, we've been in this situation many, many times in many deals. And how do you decide if you're going to get fully out, partially out, or
how do you decide? And I was at a dinner party a few nights before I had to make this decision with one of my LPs, and he said something that I thought was incredibly useful. He said, Martin, it doesn't matter what decision you make, it's going to be wrong. Because the future value of that asset, you're being offered a value at a point in time. The future value of that asset will be different 100% of the time. It's either going to be higher or lower. So if you sell part of it, you're going to be wrong, because if it goes up, you're going to wish you hadn't sold more as much. If it goes down, you're going to wish you had sold more. If you sell all of it, you might be right. There's a 50-50 chance that you're right. If you sell none of it, there's a 50-50 chance you're right. If you sell part of it, there's a 100% chance you're wrong.
Yep, exactly.
So those are the four options. So the way I decided is I had to, first of all, check to see if it was a fair price. Second of all, I had to talk to the CEO and understand the future growth potential of the company. And he told me about their new products and their plan for this year and blah, 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 blah. And then the last thing I had to do is decide, is this still core to my thesis? And the last thing I had to decide is there anything better I could do with the money? Because it's really about the opportunity cost at that point.
And this was a fund investment in your case.
It's a fund investment. So then I had to ask myself, if I returned capital, are there benefits to the LPs, and would those LPs want to do something with the capital, blah, blah, blah. In this case, in that first one, I thought that the company was launching a new product into a new market segment. They'd been very successful in their initial market segment. They were going into a new market with a different product, which had different unit economics. And I thought there was a significant amount of risk in that new product. And the company had grown 300% last year, but they were planning to double again this year. But doubling from 200 million is to 400 million. And that's a lot of revenue in 1 year. So I thought there was pretty significant risk in that upside. So anyway, and I also said, if I'm going to be wrong, I might as well be wrong with some money in my pocket, right? So I decided that in that case to sell 40% of my shares, which was a little more than I had originally thought at 20. I'm in another venture fund that's in the same deal. They only sold 10% of their shares. But I decided to sell a little bit more because my summary was that the risk in the future growth was more significant than
You're sort of hedging your bet.
So I hedged my bets. I sold 40%. I returned 3x capital in instead of 8x, and we let the 60% roll on there. I'm pretty happy with that scenario. The second one was also a CPG company. A company that did last year about $57 million in revenue, had about 9% EBITDA, had grown 10x from the year before, was profitable. And in this case, a PE fund was offering to buy 45% of the company. And in that case, so in the first case, the company was buying some shares back, really just to reduce the number of share count and increase the share multiple, but they had piles of cash. It was not a new investor. In this case, you have a PE fund coming in, and PE funds want to make at least 2 to 3x their money over a 3 to 5 year period of time. So you have a new investor pricing the company, wanting to make 2 to 3x times its money. So I think in this case might have a slightly higher conviction that the company is going to be worth more in the future because you have a new investor putting in new capital, betting on the growth. And, bringing some assets and management team and distribution and all these other things. So you could potentially, in that second scenario, have a higher degree of confidence in a future upside because you've got a new investor paying this high price. They were paying approximately 2.2x revenue and about 18 times EBITDA, which was even a greater premium than the first one in CPG. So the price
this was also a CPG company, or this is a different
also a CPG company.
Okay.
So the price was more than fair, and I think reflected the bullishness that this new investor had on that particular company. Now, the first company was a company that made a product that I actually personally use every day, and I loved it. That's one reason I held it, because I like it. The second company is a baby food company, and we bought it when our kids were little, and we used it, and we don't use it anymore. So it did not align with my thesis going forward.
And this was also a fund investment in this case?
This is also a fund investment.
Okay. Yeah.
And, oh, no, this was a personal investment.
Personal investment. Okay.
So in this case, I didn't have LPs to consider, and it didn't align. I mean, it wasn't a company that I was passionate about anymore because it was a baby food company. In that case, I did have other things I wanted to do personally with the money. So in that case, I decided to sell all my shares. And that was a 12x in 4 years.
Wow.
Which is not terrible. It's actually pretty good, especially in a CPG company.
Oh yeah.
So
especially now.
Especially now, right? I mean, I could have potentially helped, but I had some personal thing, but tipped the scale for me is I had personal things I wanted to do with the money and, booking a 12.
And it was a good return anyway.
It was a good return. It was a more than fair price. I could have held, but my wife wanted new floors in the house, so we.
There you go. Exactly.
She's like, I don't want to wait another 5 years for my floors in my house.
Yep. Exactly. But I think it's important to share that because it's all about the motivations of the people involved, right? So if it's your money and you're an angel and you're making a decision, that's a very different decision than you might make if you're a fund manager. Yes. And you're making a decision on behalf of your LPs. Yes. Yeah.
I think it's slightly harder if you're a fund manager because, you make fund investments to try to make, 10, 20 times your money. And if you're offered 2 or 3 or 4, it's a little harder to make that decision. At the same time, if you had like that first one, part of the reason I decided to take a partial exit as well is that in that fund, I had not had any DPI yet. And I thought there was a big benefit to giving LPs back some money. And, that's part of the fund manager calculation. It's like,
exactly. Yeah.
What's DPI valuable for you?
Exactly. It's like, depends on where you are in that life cycle of the fund and how much you've been returned. And I think that's something that maybe a lot of LPs and other investors, even founders, don't really realize about the motivations behind a decision to get out or stay in over time. Super cool. So I guess coming to the end here, all of this was, I think, such an interesting episode because it really hit on 3 different ways that you could be involved in an exit. So any final thoughts or anything else you want to share?
The biggest takeaway for me on exits is that unless you're selling the entire company to one thing, most things people think are exits are not final exits. They're just fundraising events that require you to continue to operate something. And this whole idea of an exit being the end is, I think, a bad thing for the whole industry. Anybody who buys your company is going to want to grow it from where they're buying it from you. So there's more work to do after the exit. This idea that exits are the end of your work or the end of your ability to make money on what you build, I don't think that's a useful thing for people to think about.
Yeah, could not agree more. Well, thank you so much, Martin. This was incredible. That's a wrap.